J-Blog, 25th of September 2011. Starting out by looking at the New York Composite. Obviously, some interesting things happened over the last few weeks. I haven't done one of these in a month or so. Pretty clear head and shoulders formation here. We've got a head here, left shoulder, right shoulder. In fact, it's a bit of a double shoulder. And that neckline was penetrated and then went down from there. It tried to rally 1, 2, 3 times, and now it's fallen lower. The market didn't particularly like what Bernanke had to say. I personally think that Bernanke did in fact make the right choice by not announcing QE3. It is time the market learns to stand on its own feet and stops looking for handouts from the Fed. So I'm all in favor of that, but of course the market did not like it. And fundamentally nothing changed in the last 5 days. We are still in trouble. We'll continue to be in trouble for quite a while. And I think CNBC and the talking heads have not been doing the market any kindness for talking up an economy that is simply entirely too weak. QE1 did some stuff, basically saved the banking sector. QE2 didn't do anything because we basically rolled back everything we gained. In QE2, if you look at the S&P 500 here, this is when QE2 basically happened right here, and we've pretty well rolled all of this back down again. Now the big question on everybody's mind, of course, is this it? Is the market going to go up from here, or is it going to go further down? I still personally have a sneaking suspicion that we will once again test the lows over here that we made 2 years ago, but we might not get there right away. I doubt that the drop would be quite as dramatic as it was in 2008. It might be a much longer and more drawn out affair. In the near term, of course, we had substantial drop on Thursday and Friday. And Friday actually was a little bit stronger here. We might have established a temporary bottom, and I would assume we can swing back up a little bit, and then I believe there's a good chance we might just drop further down. September, October, not very good months of the year when it comes to the stock market, especially when the financial stimulus is removed. If we're looking at if we look at the core sectors as compared to the overall market, so this is the S&P 500 right here, and of course we had massive volume on Thursday, and then on Friday it was pretty average volume, still higher than if we go back historically. The exponential moving average 10/30 was the red, the fast line below the slow line, so that still says bearish market. And I said I wouldn't take out any big positions. I'm mostly in cash right now, to tell you the truth. I prefer not to have my head sticking out too far because this market could go either way. It's just entirely too much emotion in it. So this is materials, basically reflects the overall market, nothing new there. Energies are a little bit stronger than the market. This blue line that you see here is the S&P 500 as compared to this. So the energy market is a little bit stronger than the S&P. The financials reflect pretty well the S&P as it is right now. The industrials, again, really a mirror image of the S&P, and technology has outperformed the S&P by a little bit, of course, on the strength of companies like Apple, which is still going very strong, surprisingly strong. Um, then we have consumer staples, which has far out performed the S&P, which again states that we are in a contraction, in a recession, because that's when consumer staples will actually outperform. Utilities, same thing. Utilities actually doing very well. And again, that uh, happens when you are in a recession. And then healthcare, a little bit weaker, but still stronger than the overall market. And consumer discretionaries is stronger than the rest of the market, which once again is surprising. The certain part of the population that is doing very well, I had a comment on that the other day, is the 20% that are doing extremely well, and the 80% that are not doing well are doing quite poorly. So, upper end retailers like Tiffany's are doing extremely well at this point because there's a certain class of people that are doing extremely well right now. The vast majority is not, which is, of course, unfortunate. Going over to oil, oil has dropped into the 80s. How much further does it have to drop? Not that far, just because, in my mind, there's a certain limit at which oil is simply can no longer be produced, um, and that point is somewhere around 60 to 70 to $80. Really, that's what it costs these days to make a barrel of oil. So can this drop much further? Yes, but only temporarily. Natural gas has dropped off a little bit, not very much. It's pretty flat. Gasoline is a good sign that gasoline is dropping. Wholesale gasoline now at 252. Gold, of course, got sold off substantially on Friday. The market thought that QE3 was already priced in and that there would be huge inflation. I'm personally on the deflation camp. I'm believing that things will actually get cheaper rather than more expensive, and therefore gold is not really as necessary as it is, and it looks like the market agreed with that. I sold gold short somewhere around here, covered it, and then sold it short a little more and covered unfortunately way too soon. I didn't think gold would drop off this far, this fast, but it did. Silver is looking very pathetic. It's actually dropped below the 200-day moving average here. So silver is very weak. It is the volatile one of the two precious metals, and it actually is starting to look interesting again. Maybe I'll buy a bit. So here's the gold silver exchange rate has spiked quite heavily. Um, Gold in euros once again has dropped as well. So this is not just a US dollar move, even though it is a bit of a US dollar move, but it is a gold move. It's important to differentiate what is a gold move and what is a US dollar move. The VIX, of course, is now high. Everybody is scared. What took them so long to get here, I don't know, but it is high, 42. US dollar is, of course, going up, and that is the reason why holding cash right now is not a bad thing, because cash is becoming more valuable compared to other things. Copper. Again, copper, the metal was the PhD in economics, is telling us economically we're in trouble because it has dropped. China is finally signaling that it is slowing down a bit, which will account for less copper use, and the volume on that is massive as well. So all of that doesn't really spell a very bullish picture. If it was bullish, at least copper should be taking off here and not dropping as it does to 330 and 320. So overall, the market is weak. We might have a bounce here. There's certain stocks that do extremely well, that are very strong at this point, but the overall market is quite weak. And fundamentally, I don't really see that as a problem. I see the market is finally reflecting the economic realities that are out there. That doesn't make me particularly glad, but at least it makes sense. That's all I have for today. So as I said, I'm basically sitting on the fence, a lot of cash right now. I've got some shorts, I've got some very select long companies. I've sold out of all of my gold, and I've sold out of all of my gold companies for the time being. And yeah, just sitting by, waiting, seeing which way this can go. This can go any which way. So that's all I have. All the best. Good luck next week. Bye.